Hi everyone, my name is Palesa Trolwe from Invelo Wealth Solutions. Today I'm going to chat to you about financial and money management. The important learning outcomes with what I'm going to speak about today are to understand the importance of financial management, to know which financial reports are important and why, to make key decisions regarding cost, revenue, profitability, and management using the financial reports, to simplify the major accounting terms that are available out there, to be able to read financial reports in order to make decisions, to be able to make performance evaluations for your organization, and to be able to perform basic budgeting exercise. By way of introduction, I thought it was important to make you understand why financial management or money management is important in the context of business and entrepreneurship. So just to begin, entrepreneurs by nature, they spend their time figuring out which customers to listen to, which customers to ignore, how to do product prioritization, which product features are important, which markets to start targeting, etc., etc. This means that as an entrepreneur, your time is spent creating something new under extreme uncertainty. As an entrepreneur, you make things happen. You are optimistic. I mean, you are expected to be optimistic. You have a vision. That's why you are an entrepreneur. And of course, as an entrepreneur, you must be able to pull everything together to make sure that you put your product or your services to the market. Unfortunately, as a business owner or the entrepreneur, you also need to think like an investor, not just as an entrepreneur. So, what does an investor think about? An investor is concerned about how much money they are likely going to use, how to do resource allocation, how to protect the business's downside if something goes wrong. So essentially, financial management is here to pull the two together. The side of you being an entrepreneur, as well as the side of you being an investor, because by virtue of starting a business, it means that you are an investor in your business. So how does financial management do this? In summary, financial management is concerned with profitability of the business, expenses, cash, as well as credit. It is there to provide means for the organization to carry out its objectives in order to maximize the value for shareholders. Remember, as an entrepreneur, as an investor, you are also a shareholder. So you need to be able to find ways to maximize value for your business. So, what is financial management? In simple put, financial management is art and science of managing money. That's it. Art and science of managing money. It's about planning and budgeting. It's about the way you're going to allocate the resources. And we know that when you're starting out as a business, your resources are naturally limited. And so you need to be able to allocate those limited resources. You need to be able to operate, monitor, and protect the business's bottom line. And of course, financial management is going to assist you in evaluating as well as being able to produce reports that can tell whoever's interested in your business how your business is performing. There are three goals in financial management that entrepreneurs or business owners are trying to achieve. Those goals include financing decisions, investment decisions, as well as dividend decisions. If we speak of financing decisions, they involve where, when, and how to get the finances for the operations. Of course, at the beginning of your business, you might have some funds to invest in your business. And of course, you then need to know how to allocate those funds with regards to the activities that you need to engage in your business. Once you have decided how to allocate the finances that you have within your business for your operations, you then are hoping that your business is going well, you have satisfied your liabilities, you have paid your expenses, and you are now starting to generate some level of income or revenue for the business. If the business is now making more revenue than the cost, then you get to a point where the business is starting to become profitable. Of course, I'm putting this in a very simple way, but you do need to understand that it's not as simple as it's put. Generally, a business that is starting out right now is likely going to take 3 to 5 years before it can start making a profit. And you need to appreciate that and you need to be prepared for this. So, initially, within the first 3 years, what you're striving for in business is you're striving to just break even. So, breaking even means that your revenue is at least able to cover your expenses. And of course, if you get to a point where you are able to generate profits, that's fantastic. If you can get to that point within the first 3 years, that's even great. But majority of businesses will take at least 3 to 5 years, as I mentioned, to be able to generate profits for the business. Now then comes the next goal of financial management, being once you are generating the profit, what do you do with that profit? You need to make an investment decision. That investment decision entails allocating the capital that you have generated. Remember the profits that I've mentioned. Now you need to allocate these funds to long-term assets in order to maximize the return on investment for the company while you are trying by all means to minimize the risk. Now, there are certain activities that you may get excited about in investing in. And we're going to touch a little bit later on in terms of what is it that you should be investing your money on when your business is still failing you and what you shouldn't or what you should try to avoid. But you now need to make an investment decision. You need to decide whether you're going to be buying assets for the business or you're going to be hiring more people for the business so that you can scale the business. And if the business is scalable, then you probably would want to invest more into scaling the business. However, this is a difficult decision to make. There's a lot of assessments that you need to do, evaluations that you need to do. You need to talk to people within your industry. You need to evaluate the performance of the business. You need to be sure in terms of where the business is and if the business will be able to take on an additional investment. Once you've decided how you're going to allocate the funds, and often there's two investment decisions that a business can make. The one is to either invest in the growth of the business, and the other one would be to pay the dividends. Businesses that are still in the growth phase don't often go for paying dividends to shareholders because once you pay the dividends to shareholders, it means money out of the business. So businesses would usually then return or retain those earnings within the business in order to grow the business, especially if the business is in the growth phase. And I'm thinking a business that is 5 years old or 3 to 5 years old is still in the growth phase. So perhaps it's not an excellent idea then to pay dividends. But let's say for some luck, your business did so well within the first 3 years or within the first 5 years in such a way that your business is able to start paying out dividends, then you would want to be able to make those difficult decisions and be able to pay the dividends. And that would be the third goal in terms of financial management, dividend decision making. And so you then decide how much dividends you're going to pay to your investors, including yourself. Remember, you are also a shareholder. You could have venture capitalists as shareholders. You could have other type of businesses that are shareholders in your business. But bottom line is, should you decide that the business is ready to make to pay out profits, then you would have to make that decision and start paying those dividends. Let's assume then that you haven't paid the dividends, or let's assume that before you pay the dividends, you made sure that the business is in the right space. The next item that I want to speak about when it comes to financial management is tools that are available for you as an entrepreneur in order to be able to perform financial management for your business. Typically, the financial reports that are available is what we call a balance sheet. This is one of the common ones. Balance sheet shows the company's assets and liabilities over a fixed period of time, as well as shareholders' equity. Shareholders' equity refers to the profits that you would be paying, or the equity that will be there for the shareholders, whether it's paid out or it's retained, but it is the shareholders' equity. You also have income statement. An income statement is a type of financial statement that will show you the profit or the loss of the business. It shows the company's revenue or income versus expenses. Your income statement provides valuable insights into the company's operations, the efficiency of its management, underperforming areas in the business, as well as the performing areas relative to industry peers or your competitors. The next financial statement is your cash flow statement. Cash flow statement is very key to any business, and you will understand why I'm saying this later. Your cash flow statement allows the investor to understand how the company's operations are running. Where is the money coming from? Where is the money going? And how is the money being spent in general in the business? A lot of companies, including ourselves, we use what we call management accounts. The nice thing about management accounts is that they are quite easy to do, even for someone who is not into finance. Because once you've got a spreadsheet that has been created, all you need to do is just to plug in your figures on a monthly basis, just to make sure you understand what is happening within your business. So it's typically things like, as and when money is coming into the business, you record each and every transaction. As and when money leaves the business, whether it's through a debit order or you've paid an expense, you've paid for, let's say you are buying, stationery for the business, you're paying, an IT company to assist you with certain things, all those transactions must be recorded in your cash flow statement or in your management accounts, because these management accounts will assist you when it comes to then generating statements, and will assist your accountant when it comes to generating statements such as your income statement as well as your balance sheet. So very key and highly important for you to be comfortable in doing such exercises. Yes, you can employ someone to run management accounts for you, to do your cash flow statements for you. However, it does come at a cost, and if you want to manage cost in your business, you must be willing to be able to do or to try and learn to do some of these functions, especially functions that are easy, that are just plug and play. Then, of course, another important financial statement. This is not the main financial statement that a lot of companies or your investors would want to know about all the time, but this is again another important statement for you to generate for yourself, even if you're just using a plain Excel spreadsheet. This is your revenue or your cash flow projection statement. Literally, you can use Excel to just put this together. All you need when you're putting together your cash flow statement, you just need to put your months in the year. You then need to say how much you are expecting to generate in terms of revenue on a monthly basis and how much are you expecting to spend. And your cash flow statement that you would have generated will give you an idea of how much your expenditures are on a monthly basis and how much your expected revenue is. But this is also the type of statement, your revenue projection is also the type of statement that you're going to put in all your business pipeline or your hopes in terms of business. What is it that you think you're going to get in terms of business? So let's say this month you have generated a revenue of 10,000. You can then say, because you're going to have 3 clients the following month, you can then in your projection say, in February, I know it's a good month, it's going to be a good month because I've got 3 clients that have promised to sign or have promised to buy my product. Then I'm going to put in 30,000 as my projection for the following month. Also, in terms of your cash projections, the important thing is to understand how the cycles in your industry work. So some cycles or some businesses are cyclical. In certain months, they don't do well. In certain months, they do very well. And so when you do your revenue projections, you will then factor that in. If you know that generally December is a good month for you, then you will have a higher projection for December than you would have, let's say, for September, because perhaps we know that September is normally a bad month, or maybe we know that in January is normally a bad month, then you would have a lower projection for January. However, overall, you must be able to then look at a 12-month period and be able to tell over a rolling 12 months what revenue are you expecting and how much is going to be the cost. Because what this helps you with, it helps you to determine how much funding you're then going to need if you have a shortfall between what your cash projections are as well as what your expenses are going to be. And that brings us to the next topic. So you need to then determine if your expenses, for instance, are higher than your actual revenue projections, then you need to make a decision in terms of where you're going to raise funds. And in this, we talk about capital structures of the organization. So there are essentially 2 capital structures that are available to entrepreneurs in general. You get debt as well as equity. Debt is typically sourced from creditors. Your creditors could be the bank, it could be micro lenders, it could be other financial institutions that are willing to fund your business through debt. Capital structures. There are essentially two main capital structures that you can source funds from. Essentially, capital structures refers to how an organization is going to source its funds in order to operate and grow. It's important to understand what your capital structures are, because you will need those capital structures, or you may need some form of funding in your business, especially if your business, your cash, your revenue is below your actual expenditure. And this happens all the time, and I'm not going to lie, it happens all the time with new businesses, that your revenue is slightly less than what your expenses are within your first few years. Although you want to try and manage this to the best of your ability, however, it's not always possible. And so then you might need to source some kind of funding. So as I mentioned, two sources. First one is debt. Debt is typically sourced from creditors, mainly financial institutions. You may find other organizations in your industry that are willing to borrow you funds in order to be able to start your business, but mainly debt as a type of capital structure would generally come from financial institutions such as banks and other micro lenders. Generally, they would charge you an interest. You do need to understand that they have no ownership rights in your business. They don't get involved in the company's strategic decisions, and they have the right to be paid first before the company can distribute any profits. If you are lucky, you may get into a transaction where a lender is borrowing you money and they give you a moratorium which says you don't need to pay this money back up until such and such time. Or you will start paying interest at this rate, and you will start paying the capital at such and such rate. Bottom line is, if you are financing your business through debt, you can never be able to pay out profits to the shareholders up until you have paid off your debts, and that's important. However, the advantage is that because they are not owners of the business, your lenders are not owners of the business, then they don't have to get involved, or they don't get involved in the company's strategic decisions. So that is one way. Another way to finance your business is through equity. As an investor yourself, you might have already raised some funds in order to be able to finance your business, especially at the beginning. You may also have family members and hopefully friends, but also you do find other businesses that are willing to invest in your business. You find venture capitalists that would want to invest in your business. What you do need to understand with this type of funding structure or capital structure is that often the person who's going to be investing in your business, not lending you the money, they will want to get involved in the strategic decision making in the business. They will also want to have some ownership rights. If you don't want anyone to get involved in your business other than yourself, then best you raise the funds yourself, and maybe perhaps only consider debt as another form of raising capital. But if you've got shareholders that have invested in your business, then do expect that they will want to get involved in certain decision making. So those decisions could include hiring certain people, firing certain people, deciding on which direction the business is going to go, deciding on certain investment decisions, to either make some investment decisions or not to make some investment decisions. It can be very difficult for someone who doesn't want other people to get involved. But if you are willing and you have people that you know will actually assist the business when they get involved, then perhaps this could be the greatest way to raise capital. The nice thing about equity investors is that they understand that they can only be paid last. What it means is, for as long as the business is unable to make profits, investors or your equity investors can never expect to get a dividend from you. Also, what's nice about investors, equity investors, is that even when the business starts making profits, they are in a position to understand if a business is still in the growing phase and it's not able to pay dividends, they are willing to understand, or they should be willing to understand, that the business is not able to make any dividend payments and that the business is still in the growth phase. The business still needs to invest in the business. Of course, many businesses are using a combination of the two, debt as well as equity, in terms of funding structures. The advantage of using both is that you, as a business, are able to maximize on shareholders' value while you're minimizing the risk for the business. So, what are some of the essential things that a business is supposed to do when it comes to financial management? A business is supposed to plan. Planning, planning, planning. We can never emphasize planning. You do your business plan when you start the business, but you also do your business plan as a business on a regular basis, pretty much every year and every quarter. You're supposed to revisit your business plan. Every now and then, when there's a change in your business, you're supposed to revisit the business plan. And there's just a few things that you need to make sure you do on a regular basis when it comes to business planning, or financial planning, as we call it. So, firstly, you need to assess the business environment. You need to know who's your customer, where are they coming from, what is your target market, what are some of the things that you should be doing, and what are some of the things that you shouldn't be doing. Just assess your environment, your competitors. How is the microenvironment doing? How is the macro environment doing? The economics of the country and everything else in between. Secondly, you need to confirm the business vision and the objectives. So, in other words, you need to make sure that the vision of the business is in line with the objections that the business is trying to perform. You need to identify the resources that you need to be able to achieve these objectives that you would have identified for yourself or for the business. You need to be able to quantify the amount of resources that you're going to need. So, in other words, if you have identified that the resources that you need, you're going to need people, you're going to need machinery, and you're going to need an office space. You need to then be able to quantify how much each of these resources is going to cost you. You then need to calculate how much this cost is going to be in relation to the revenue that you are likely going to get. And then you need to get down to putting together something we call a budget. Now, there are many budget templates that are available online. Please feel free to go online and download one that would be relevant for you or for the type of business that you do. Majority of budgeting tools that are available are actually they're actually easy to use, and they are freely available. You don't have to pay for them. Should you need to pay for a budgeting template, then perhaps you need to be worried. But in general, a lot of budgeting tools are freely available for people to use. You then need to summarize your costs and identify any issues that are likely going to happen, because the importance, or what financial planning enables you to do, is it enables you to look at the risk that you are likely to face. And I know, as an entrepreneur, the last thing that you want to focus on, or the last thing that you think about, is what could go wrong. But remember, as an investor, you need to think of what could go wrong and identify as well as measure any of those cost implications that are likely to affect your business operations. So I thought it would be nice to just understand what a budgeting tool is going to do for you. A budgeting tool is a budgeting exercise in general is a very imperative financial planning exercise. What a budget does for you is it depicts what to expect, so what is going to be expenditure and what you are likely to earn over time. So you'll have two columns there: how much you're going to earn, how much you're going to spend. You can use the cash flow the cash projection that I mentioned earlier. You can also use that as your budgeting tool. But if you want to separate the two, then you are able to then separate the two and have one budgeting tool and one projection tool. A budgeting exercise will enable you to categorize how much you're going to spend in each of the type of business activities that you're going to be engaging in. But no, not only that, there are other expenses that you need to take into account. And these expenses may not necessarily be expenses that are generating money for the business, but you need to be aware of them and you need to put them in your budget. This could include things like rent, if you decide to have office premises. You can have things like salaries if you've decided to have additional people, or yourself actually, because as an entrepreneur or as a business owner, it's important for yourself to pay yourself a salary. We can talk about how much that salary is, if it's high, if it's too high or it's too low in relation to the revenue that you're generating, but you need to be able to pay yourself a salary. You need to understand what are some of the cost of sales, things like petrol, in order for you to be able to go to and from a place. You need to be able to understand things like if the type of business that you run will require a vehicle, that is part of cost of sales if you have to go and make deliveries. So things like those need to be included, and you need to understand how much those are going to be. Budgets are useful for planning your finances and then tracking if you're operating according to plan. It's useful for projecting how much money you'll need for major initiatives. So let's say the business is already operational and you then realize that you need to make a big investment decision. So in other words, you decide to buy an equipment or hire a new employee. Within your budget, or if you have done your budgeting exercise, you should have already anticipated this and you should have included the cost of this. And your budgeting exercise will enable you, or will tell you if this is going to be possible or not going to be possible. A budgeting exercise is something, as I mentioned, that should be done on a yearly basis, and it includes things like your cash that is available within the business. How do you use that cash? Overall, a format of a budget is to record planned income as well as planned expenses over a fixed period of time. A fixed period of time could be a year, it could be 6 months, it could be 3 months. It will depend on the type of business that you are in. Some businesses, they have they take a bit of time, and some businesses are quicker. I mentioned earlier that a cash flow statement is one of the key financial statements that are important in the business. Not just the statement that is important, but the actual cash flow management, which you do through your cash flow statement, is important. But why do we always say that cash flow is important? I often hear people saying that the lifeblood of any business is, with no doubt, cash flow, because you need to pay people, you need to pay yourself, you need to invest in your resources, you need to be able to buy whatever it is that you need to buy in order for the business to continue. You need to put together whatever product it is that you need to put together through some form of financing. And so then it's very important to constantly have that cash available in order to be able to do those things. As a new business, your biggest challenge is going to be managing your cash flow. The reason why I say this is because as a new business, you don't yet know how much your costs are going to be versus your expenses. You don't know everything. As much as you would have done your budget, as much as you would have done your cash projections and everything else that I've mentioned so far, you are still not sure what is likely going to happen or what life can throw at your business. And so it makes it a bit more challenging, and that's why you need to be ready. The most important financial statement for the new business is the cash flow statement, as I mentioned. The overall purpose of you managing your cash flow is to make sure that you have enough cash to pay for your bills, particularly your current bills. Be able to buy whatever it is that you need to buy, be able to pay for people that you need to pay, be able to put together the products and services that you need to put together in order to generate revenue and hopefully ultimately generate some profits. Businesses can manage cash flow by examining cash flow statements as well as revenue, as well as cash flow projections on a regular basis. If you're doing this intermittently, you're going to have a problem. But if you're doing this on a more regular basis, especially if you are still starting, I would even say on a month to month basis, then you should be okay when it comes to cash flow, because you would know exactly how much is in your possession and how much it is that you need to actually spend. Do remember that some of the customers that you would have sold to might not necessarily pay you on time, or you would have given them payment terms, because as much as you would not want to give payment terms, if your competitors are giving payment terms, then you're going to have a problem if you're saying you're not giving payment terms to your customers. Also, if you are maybe a contractor, let's say you work with the government, we do know that sometimes you don't get paid as quickly as you are hoping to be paid. You would have spent money to put together the product or the service that you are giving out there. However, the people that are supposed to pay you take a bit of time to pay you back. And so that affects your cash flow. So there are so many things that can happen in the business that can affect the cash flow. The key when it comes to managing your cash flow is making sure that you keep the cash in your possession for as long as possible. If it means don't make certain investment decisions, so in other words, don't buy certain items or do without certain items because they need you to spend money, then certainly do that, because what you don't want is to find yourself in a position where the business does not have enough cash to operate. Other important considerations in a business, especially in the context of a startup business, include expenses. I'm going to chat a little bit about expenses and how to manage your business. I'm also going to touch a little bit on taxes as well as insurance and investment decisions that you need to make as important considerations as a startup business. Going back to expenses, this is one of the areas that throws a lot of entrepreneurs off when it comes to managing cash flow that we've just spoken about now. A startup business has many expenses potentially, but you want to try and ensure that you minimize your expenses as much as you can. And so there are certain things that you need to be putting in your mind before you actually spend. Number one, be an employee in your company. It is so easy when your business gets this big deal and is able to generate or has made so much money and the funds have now been paid into your bank account, it's easy to get excited and want to go and spend that money. If you have your own salary within the business, I did say however much the salary is, you will decide based on the type of business you are running. You will decide what is too high and what is too low. But let's say you've decided that the amount of money that you are getting paid, it's easy to use 10,000, so I'm going to use 10,000. Let's say you're getting paid 10,000 on a monthly basis. You stick to the 10,000. You are an employee in your business, and you then make sure that you don't take anything more than that 10,000 that you've agreed to take between yourself and your business. Stick to that no matter what and no matter how the business is performing until such time the business is able to then increase your salary. And your business can only be in a position to increase your salary if it's in a position to start making profits. Try to see your personal as well as your business expenses as a percentage of your revenue. You see, if you're just saying 10,000 and your revenue is 50,000, you could easily say, I'm not taking a lot of money from my business. But if you say, I'm taking 10,000 from the business and the revenue for the business is 50,000, and that is 20% of the entire revenue, then you'll see if you're in trouble or not. 20% will tell you exactly how much you are taking in terms of your business as well as your personal expenses in relation to everything else that you need to do. Because within whatever the business is generating, the revenue that the business is generating, then you would know also what other expenses are there for the business and what percentage they constitute when it comes to your business. That way you can see how big the impact will be on the overall profitability of the business. Track your expenses regularly. Regularly. Keep each and every slip. Create something like an Excel spreadsheet for yourself and record each and every transaction that you are doing within your business. If you are lucky enough and if you are resourceful, then you can even find a software online that can assist you in tracking your expenditure. I know that for entrepreneurs, worrying about finances or financial management is the last thing in your head. You are worried about your target market, you are worried about the product that you're going to be putting out there, the service, and everything else in between. If it's possible, then perhaps the entire accounting exercise that I've just spoken about is something that you maybe should look at outsourcing. A lot of accounting companies, because there are many small accounting companies out there, are willing to assist for a small fee. So speak to people that you know. They may be starting out as well. They may be willing to listen and they may be willing to work together with you and make sure that both yourselves as well as them are able to work together in order to be able to achieve a common ground. So outsource any function that you are unable to perform yourself or that you find that it's a bit challenging for you. And one of them is the accounting function. Avoid spending on certain things unless you have thoroughly assessed the need for it. Yes, everything is important, but not everything is important now. So within each and every function that you need to perform for your business to make sure that your business is off the ground and that it's running, there are certain functions that you can do without. There are certain expenditures that you can do without. A typical one, and one of the common ones, is having an office. You don't always need to operate from an office. In fact, COVID has showed us that you can actually operate your business either at home or let's just say outside the office. Rental can be an expense that is painful because often it doesn't actually generate an income for you. So try and avoid expenses like those. There are many others. Before you spend on anything, before you put something as a requirement or as a need in terms of your expenses, always just evaluate if it's something that you can do without, it's something that you can outsource at a smaller fee, or it's something that you can do yourself. If you can do yourself, even better. The key when it comes to your expenses is ask yourself if it's going to generate an income for you. If it's going to generate an income for you within a short to medium term, then perhaps it's an exercise that you can undertake. But if it will not, if it's a nice to have, then perhaps it's something that you can do without. Once again, to reiterate, keep a record of each and every item that you spend your money on because most of your financial reports will rely on those expenses or will need those records in order to validate whether an expense was indeed for the business or it was for pleasure. Of course, also keep it for tax purposes. When it comes to tax, never, ever ignore your taxes. It's easy as a new business to think that because you haven't reached a certain revenue generation, then perhaps the business doesn't need to pay for taxes. There are other things that will need you to be aware of how much taxes you may need to pay towards SARS, or just be aware of taxes that may be needed from your business so that you remain compliant. So go to the SARS website to get an idea of some of those important taxes that you need to be aware of. Some of them include payee. So if you have an employee that you are employing, the business might not necessarily be paying tax, but you do still need to pay tax for the employee. If you are saying their income is, let's say, 15,000 a month or 20,000 a month, whatever the amount is, then they could be pay as you earn tax that needs to be paid towards SARS. But be aware, don't just ignore it. UIF, once you employ someone, you then need to make sure that you register them with UIF, and often you will pay your UIF through SARS. You may get to a point where your business has generated so much revenue, even if the revenue is still below your your expenses or your cost. If your revenue is at a certain level, for instance, if you've done 1 million and above in terms of revenue, then you need to be registered for VAT. And doesn't mean that you will be liable each and every month or each and every period to pay VAT, because you could get certain benefits as a VAT registered vendor. And so you just need to make sure that you have someone who's running your books, and that you are very much aware of what's your liability when it comes to tax and where SARS is involved. Again, this could be a difficult exercise. It could be difficult for someone who's focusing on putting together a product to worry about SARS and taxes and all those things. And so, if you are not in a position to be able to focus on this aspect of your business that is very important, then perhaps consider hiring someone at a small fee, or having an agreement with someone that you know at a small fee, just to make sure that these things still do happen. Another important aspect when it comes to business and financial management is insurance as well as investments. Often, when the business is still starting out, we are likely to think that we cannot be able to invest on behalf of our businesses. Insurance, last thing on our heads. Why should we even be thinking insurance? With that said, those are very key, because remember, I said that in your business, you are the entrepreneur, which means you are worrying about the products and the services and all those great things that will move your product or the service that you are offering. But at the same time, you are an investor, and as an investor, you also need to worry about what could go wrong. And that's where insurance and investments come into the picture. So each industry has certain types of insurances that are an absolute must when it comes to risk management. Investments, yes, perhaps not a must, but maybe needed, or maybe something that you could consider to make sure that you keep your business liquid, or to make sure that you have something just in case. Remember, we mentioned cash flow, that it could be a problem sometimes. So if you've done some investments on behalf of the business, then perhaps that's where you can run to when you're having cash flow issues. So just to mention a few, and I'm not going to go into details about these types of insurance and investment needs that businesses, whether new or old, may want to consider. These include public liability, very common in certain sectors. If you are in a certain sector, you are expected to have a public liability insurance, and you would typically find this from short-term insurers. There's other types of short-term insurance protection policies, such as protecting if you've got vehicles and if you've got machinery. You want to make sure that you have insured those in case of theft, in case they break, and all sorts of other things. Not every industry, but in some industries, there is a requirement to make sure that your employees belong to a provident fund or a pension fund of some sort. That is the type of an investment. You're investing in your people, but at the same time, you're insuring your business just in case someone says you're not going to get a certain contract because you don't have this. Bargaining council. Some industries have to belong to bargaining council, or have to make sure that their employees belong to bargaining council in order to get certain contracts. So once again, this becomes a necessity. A buy and sell insurance, a type of insurance that if you are in a partnership business, or you are in a business that have other shareholders, you want to make sure that you look into. A contingent liability. Remember, we spoke about financing your business through debts or a debt. If you're financing your business through debt, then there could be a requirement for you to make sure that you've got surety. And a contingent liability policy is a type of insurance that can assist you in assuring your lender that if anything happens to you, you will still be able to finance or to pay back the money. So that's in a nutshell most of the things that you need to take into consideration when it comes to financial management. To sum it up, you also need to decide which type of entity, if you haven't decided, you're going to go into as an entrepreneur. You could decide you want to go into a sole proprietorship, you want to go into a partnership, a limited liability business, a company, and of course, a public company is not something that any person can just go into. Businesses that have evolved over time and have managed to generate certain profits at some point after 40, 50 years are then able to go public. So we're not even going to go into that. And just as a sole proprietor, do remember that there isn't a distinction between you and your business. You are wholly liable for the expenses of the business, for anything that has to do with the business, just in the same way that even when it comes to paying taxes, you are liable for everything when it comes to that business. A partnership is slightly an extension of a sole proprietorship, but there's now 2 or 3 or 4 partners within the business. A limited liability business, it is not a very common type of business unless you are in the professions such as accountancy as well as legal. Often those are the businesses that you would typically find in the space of limited liability or would have a limited liability business. Then the most common type of business is a private company. You would know that in South Africa, you would not be allowed now to open a CC. You can buy a CC off shelf, but you will not be able to create a new CC from scratch. And so then the most common type of business is opening a private company or a PTY limited company. The good thing about a PTY company is that you can have as many shareholders as you can. You're not limited. At the same time, each shareholder is responsible or liable for their share in the business. So your liability when it comes to this type of business is limited to your shareholding. And if for whatever reason you've missed on paying back your creditors, you will be liable to those creditors limited to your shareholding in the business. While someone who's running a sole proprietorship or who's in a partnership is fully liable. So, to sum it up, why it's important to have or to worry about financial management. You want to be able to understand certain types of reports that are required for different type of reasons, or you want to be able to do financial reporting. And there's many reasons why a business on a regular basis needs to be able to do financial reporting. It could be you're going to need funding. If you're going to need funding, then your funders or your potential funders will want to have access to your financial statements. They would want to know what your balance sheet looks like, what your income statement looks like, what your cash flow statement looks like, and even your projections. Sometimes they would be interested in knowing, where do you think your money is going to come from? How is that money going to be generated? Are you going to be making more money in certain months versus certain months? You also want to have your financial reports when you're applying for contracts, because often when you are applying for contracts, they would want to know who they are dealing with, and they can only be able to tell who they are dealing with or what type of business they are dealing with if you have your financial statements. If you're going to be involved in the tendering business, similarly to contracts, they want to know. You could be asked for these statements or these financial reports. And of course, within the various industries that your business or your businesses are operating in, there are regulatory requirements. If you are, for instance, operating within the financial services sector, which is where we are operating from, there's an institution called Financial Sector Conduct Authority. And just by being a member within the Financial Sector Conduct Authority, FSCA in short, you need to submit your financial statements on a yearly basis, depending on when your financial year end is. Other companies or other industries, it would be in certain intervals. Let's say it would be every June or every December. In others, it would be every February or every March, whatever the case may be. But there's different regulatory requirements depending on the industry that you are operating in. And ultimately, you may decide that you want to sell your business for whatever reason. Could be you're no longer interested in this type of business. You have found something else that you prefer to use. There's many other reasons why a business could need to be sold. Your investors, they have decided that this business is better. It would be better if it's sold than for the business to continue operating. There's many reasons. For you to be able to sell your business at a fair value, even better if you sell it and make a profit out of it, then you certainly need your financial statements. So they become very, very key to that transaction. And so the importance of financial management when it comes to business can never be emphasized enough. Once again, even if you don't have the resources or the know-how when it comes to financial management, there are ways of working around it. Do invest the time to either find someone who can assist you, to learn if you don't have the funds to do it yourself, or employ someone who's maybe going to be a financial manager to assist you in making sure that you have financial records in place, you have all the financial statements that are required, you know how to interpret them if need be, unless you have someone who can interpret them for you. And lastly, to demonstrate those reports when it becomes necessary. I am Palesa Tolwe from Imvelo Wealth Solutions. Please feel free to ask me any questions in relation to what we've spoken about, but also other things that involves financial management or just money management in general, not only for your business, but for yourself. Thank you very much.